Hey, welcome back to Two Super Guys Trade Stocks. I am Dylan.
And I'm Vinny.
And I am back to thinking the market is going to tank after this red hot inflation report. I think there's some bad things coming. We're going to look at some highlights that weren't really clearly explained, but are going to have drastic effects on the market. So let's take a look. Maybe.
Maybe.
Two Super Guys Trade Stocks. All right. So, real quick, I just want to summarize all this stuff because there's so many numbers that come out and there's so many different time frames they look at. I just kind of want to explain this first, but we're going to look at where I think we're going from here because this is bad. This is not good for the market. All right. So, the annual consumer inflation was December 6.5% to January 6.4%. So we're down 0.1. Yay. Huh?
Yay.
Yay. The core consumer inflation, which is no food or energy, that's very important, also down 0.1%, 5.7 to 5.6. Okay. Now, one thing that they look at, it's kind of like when you're looking at a stock chart and you're looking at like a 5-minute graph versus a day graph. The longer the time frame, the more information you can gather over longer time frame trends. So, in a 3-month time frame, we actually rose to 4.6% inflation from 4.3, and over a 6-month timeline, 5.3 to 5.1. So we went up. Okay. Now that part was a little expected. The part that was not expected is this. This is a problem. Okay. This is a reverse. Producer prices, so like manufacturers, farmers, wholesalers, jumped 0.7% in January after dropping 0.2 in December. That's a reversal. All right.
Yep.
We were trending down. It was almost twice as bad as the prediction. It was not good. Okay. This area will usually kind of be a price predictor for what consumers feel soon. So consumers are not going to like a giant increase in inflation. This is where it happens first. Consumers feel the brunt of that a couple months. All right?
Yeah.
Now,
As far as the CPI trailing 3 months, 6 months, Powell has talked about that before in his speeches, looking at core CPI over 3, 6, 9, 12 months.
Yeah.
So he's looking at that kind of those longer term metrics, not just like the kind of each monthly change, if you will, to watch the overall trend, like you were talking about in that first section.
Yeah, and headlines, when you type in like just Fed data, it's always the month because it's more catchy, right? No one's actually looking at the actual trend of what's happening. It's kind of like in the stock market when there's like a big bullish day and everyone's like, oh, reversal. And then like the whole zoom out is just a slide downwards. So, is this Deutsche Bank? What is this?
I mean, sure. Yeah, I mean, there are probably some douches that work there, but it's Deutsche Bank.
Deutsche Bank. All right. They basically said, hey, this whole 5.1% thing that we thought we're going to have to hit, this ain't going to do it. We're going to need 5.6, and we're going to need a 0.25 increase to the next 3 meetings.
Yeah.
That's disgusting.
One of the Federal Reserve governors actually came out this week and said that he supported 0.5% at the last meeting and would support 0.5% at the next meeting too. I don't know if that was one of the things you were about to talk about, but
it's in there. It's right here.
Yeah.
So if you just type in Fed data, right? These are all the articles that come up. It's all not good. Okay. It's all pretty bad. There was I can't remember if it was a guy or a girl, but a gentleman who said we should probably do a 0.5 instead of a 0.25 last time. The logic is, as Jerome Powell has said, it is way more beneficial to overcorrect than undercorrect. The word beneficial, probably shouldn't use beneficial. It's less harmful in the long run. It's they have more tools to what am I trying to say here? They have more tools as long as they keep going higher than if they underdo it and you have a longer, bumpier road ahead. That's what they're trying to avoid.
Agreed. Yeah, inflation, if it gets set in, it becomes much more difficult to eradicate after that point. Yeah, he's been very clear about that.
So we have four scenarios of what happens. I changed the
Okay.
color. This is a very zoomed in graph. We'll go to the actual graph too. But this blue is the 200 moving average. This is my baby here. All right.
Yeah.
So we'll look at the
Sure.
volume too. But basically, you have a retest of the 200 going up a little bit, and then, dear God, help me. Okay. It's option one. Option two, similar, but you retest highs or this mid consolidation period of about 409 to 415.
Okay.
Okay. This is option three. I don't think it's likely, but this is option three. All right. And a lot of people are going for this one. They're thinking, hey, new highs, we're going to hit 480. I think that they are smoking crack, but I don't know. And who knows for sure, right? I could be completely wrong.
Yeah.
And then this one is also decently likely. Is we go down, we retest the 200, we come back up, we chop for kind of a hell of a long time, between 3 and 6 months. No, 2 to 4 months until the next Fed meetings, and then when they don't slow down the rates, tank.
Yeah. Interesting scenarios. So, kind of a couple of things that kind of came to mind. So, there was one news article this week talking about how retail investors are pumping $1.5 billion into the stock market per day at this point in time. So, retail maybe. I'm not exactly sure where that puts it in terms of scale compared to historical, but they did say it was historically high in the article. Whether or not we're kind of banking on that reach up to 480 or something like that. Game of Trades will probably be very proud of that if that happens. The
I'm sure they would. Shout out.
Yeah, I know it's definitely been a little surprising because both bad economic news and good economic news have kind of failed to move the market significantly out of this range at this point. We've been a little bit range bound here since we broke the 200-day moving average, trying to figure out what it wants to do next. And certainly these news reports this week were a little negative. One of the things I thought was interesting that we didn't talk about yet. Did you see the consumer spending was up 3% in the month of January?
Yeah, it's not good.
That's people still have too much cash is what that tells me. People are still willing to push up prices
Well,
by spending their money.
they think they have too much cash because savings accounts are down and credit card debt's up. So there's a
Yeah.
caveat there, right?
Yeah.
It could just be our generation being idiots because I just feel like we've made so many mistakes, like money wise.
Yeah,
Not
agreed and
like
understood.
our generation as a whole. I should clarify.
Yeah, we're older millennials, so we're a little bit different.
Yeah, that's true. Well, you are. I'm 22. All
Yeah.
right. Here's the SPY here. You can see we had a little spinning. Oh my gosh, long day.
It's quite a spinning top. Looks more like a doji than me. I can't
Yeah,
really see
no,
if
no,
there's a
no,
look
no,
at
no,
the
no.
bottom.
There's no tail here. There's no tail here.
Okay.
All
All
right.
right. So yeah, spinning top.
Little bit of we'll say an upside down hammer, and then we have a hammer here. This doesn't tell us a lot because you can see we did have average volume. Anytime the stock starts like this, remember there was a battle that was fought all the way up and then came all the way back down. I don't ever put weight on Fridays for technical analysis. I just usually they're very very low volume days. This was pretty decent, but we did break this little bit lower kind of. We did set a low here, if that makes sense. Once again, it's
Yeah.
really hard to actually make that claim with this limited amount of data, right?
Understood. That would have been a monthly options expiration date this past Friday too.
Yeah.
Which
It's
can have an impact.
we're still trending down, but this was unexpected. I'll just say that this was not expected at all. This entire thing that's happening right here, it does not look like any other crash that we've seen. But every crash is unique. I'm still hella short, to be honest with you. I would like it to retest this 200, and then based off of what happens there, I'll probably exit my positions for my shorter term positions for a small loss. I still have the ones that are like not expiring for a year and a half.
Okay.
But it's definitely an interesting time in the market. Then this inflation report was bad. It was not good.
Yeah. Yeah. Are you worried you're bargaining with yourself a little bit and giving yourself more and more leeway with your kind of short position? or do you think you're being reasonably tactical and kind of nimble in this unusual trading environment? That's my question or thought about your short position.
So there's three short positions. Time frames. Sorry, there's three short position time frames. There's ones that expire in June of this year, ones that expire January next year, and then June next year. So the January and June, I'm not really worried about. The ones that are closer, I would rather not hold within 3 months because of theta decay. It gets pretty bad.
Okay.
But let's say we go and retest highs and set a new high. I lose an extra $180. Who cares?
Okay.
Right? Where the gain would be if it goes back down $3,000. So and it's completely worth it to hold. It doesn't make sense to sell. Could I lose more? Yeah, but I mean, I'm gonna lose a bunch of those shorter term options anyways. It's the other ones that I'm hoping on making cash for.
All right, fair enough. Fair enough. I was just curious what your thought process was there, because I think it's kind of interesting.
But I mean, still, the greatest thing that can happen for my account is if Nikola goes back up to $20, and then, then I'll just get all my money back. So we're good. I'll short the shit out of them.
I love it. I
All right,
love
guys.
to hear it. Catch you next one.